Recording means all the financial activities. Summary is the financial statement. Statement means balance sheet, profit and loss account, and cash flow statement. Reporting is also the statement, and analyzing or classifying is the structure of data in day-to-day activities of financial transaction. And then process of recording business transaction is called accounting. Types of bookkeeping is divided into two parts. One is the single entry system, another one is the double entry system. Single entry system is the only one aspect of accounts is used for petty cash, and then small shops are used only one entry. Examples: cash received only for maintaining the account. And then double entry system. Double entry system are dual aspects. Examples: debit and credit, asset and liability, and then income and expenses are called the double entry systems. Next, this is the journal format. Date, particulars, LF means ledger folio, and then DR means debit, CR means credit. Date, the day-to-day activity should be entered. Particulars means description of the transaction. LF means reference of the book. Debit the receiver. Credit is the giver. Next, second is the compound entry. Compound entry is also the two aspects of related. First one is the debit. Two or more accounts are debited, and then next one is the one accounts are credited. Examples: rent and insurance paid on the checks. Rent and insurance are the debit account. Checks through the bank. So bank account are credited. Next, the rules of debit and credit are the accounts. Accounts are three categories. One is the personal account, and the other one is the real account. Third one is the nominal account. Personal accounts is the rules and regulation of debit the receiver and credit to the giver. The real account nominal rules is the debit what comes in, credit what goes out. And the nominal account rules: debit all the expenses and the losses, credit all the incomes and the gains. The personal accounts is also called, the personal accounts called related to persons, individual, firms or company is called personal accounts. Example: current or creditor, capital account, etc. is called personal accounts. Real accounts means the real accounts are related to tangible or intangible assets is called the real accounts. Tangible means I can see, touch or feel is called the tangible accounts. Land and building, investment, plant and machinery, stock or cash in hand, these are all the tangible assets. And then next, intangible assets. Intangible assets are I cannot touch and I cannot feel their assets. Example: goodwill, patent rights, copyrights, these are the intangible assets. The last one is the nominal accounts. Nominal accounts called all the expenses and the losses, and all the incomes and gains are called the nominal accounts. Example: salary paid, and then interest paid, and then purchase to whatever the machinery or plant is called the nominal accounts. The three types of accounts: one is the personal, and then real. The last one is the nominal. What is the rules of accounting? Personal account rules: debit the receiver and the credit the giver. Real account rules: debit what comes in, credit what goes out. The nominal account rules: all the expenses and the losses are debit, all the incomes and gains are credit. Next, the classifications of accounts. The total 5 categories of accountancy. One is the asset accounts, liabilities, capital, revenue, and the last one is the expenses. Asset is the future benefit of accounts. Liabilities is the past event of accountancy. Capital, owners are invested in the money in the business is called capital. Revenue, earned money or income is called the revenue. Expenses, non-economic future is called expenses. These are the 5 categories of accountancy. Let us the topic of what is the basic of accountancy and the bookkeeping and the types of accounts. Thank you.